Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. If you're looking for dividend yield, there's a chance that you're like a lot of other people and you're looking at Energy Transfer right now, the midstream company with a dividend yield knocking on 10% for its forward dividend based on its most recent payout. But I'm here to tell you it might not be the best one to buy right now. I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me. We're going to tell you why Energy Transfer might not be the one to buy, but even better, we've got two stocks in the energy patch that we think might be a better fit depending on what you're looking for. Hey, Tyler.
Jason, how's it going? We just saw each other this past weekend.
Yeah, back from Omaha, Berkshire Hathaway's annual meeting. We're kind of feeling our little inner Buffett here. We're going to talk about what we think are some superior businesses over Energy Transfer. How about you kick it off and talk about Energy Transfer and what your concerns are?
The longer you follow something, you start to notice patterns. And Energy Transfer is one of those kind of companies that's been in the midstream space for a long time, and it's an industry I've followed for a while. And one thing that has always given me caution when it comes to Energy Transfer is there has been this pattern of investment decisions, acquisition decisions, and just a lot of way that management behaves that appears to be more in the interest of just growing the business for growth's sake rather than driving shareholder value. So over the past 10 years, the best year over the past 10 years, Energy Transfer posted a return on capital of 5.6%. Now let's compare that to some of its peers. ONEOK, which is a similar midstream company, natural gas pipeline, a lot of things that Energy Transfer does, and Magellan Midstream Partners, a lot of refined product pipelines, some crude oil pipelines, relatively similar businesses, right? Those two companies, their worst year on return on capital in the past decade was better than Energy Transfer's best year on return on capital. And it goes to show, at least to me, and is indicative of how much management tends to spend on acquisition, spend on growth that may not necessarily be the highest returns, but just the growth. And that's been a huge concern for me. And it's been something that's led them, perhaps why they have a 10% yield right now, why the market says you should pay me more than these other companies. You've already cut your dividend in 2020. You've had many, many years of no dividend growth. And it seems to go that you're not the best partner for shareholder capital. And because of that, I can see why investors are requiring such a high dividend to get involved with Energy Transfer.
One thing I want to add, Tyler, before we do move on, in this interest rate environment that we're now in, chances are that there's going to be even more weight on the returns for a lot of these midstream companies, simply because debt is a major part of the capital stack. These are very capital intensive businesses, and they're going to have to be rolling debt. They're going to have debt that's going to mature, that maybe it's from 5 years ago, that is going to be at much lower rates, right? They're going to have to refinance that debt at much, much higher rates. I think investors really need to be conscious of that. So with that said, I'm going to sell you out a little bit here, Tyler. The one that I'm going to recommend is one that you're not as big of a fan of as I am, and that's Phillips 66. And my thought on this one is it's a little bit less of a pure play refiner than some of the other refining companies that frankly are superior, right? As refiners, I'm not going to argue that. But the thing that I like about Phillips 66 is it's a little more diversified than most of the refining businesses. It was actually spun out of ConocoPhillips 11 or 12 years or so ago, when ConocoPhillips was a fully integrated super major. And now ConocoPhillips is just the oil producer, and Phillips 66 is everything else. It's the midstream assets. They've got more than 30,000 miles of pipes. They have a gathering business. They have a pretty large petrochemicals business that's part of a joint venture with Chevron. That's a pretty nice business. They have a pretty good refining business. They have a good marketing business where they're selling those refined products. So there's a lot of different pieces that I like. And one of the things I like about it compared to maybe some of the super majors is that if we do go through one of these downside periods, they don't really have the same downside exposure to falling oil prices that some of the super majors do, right? So if you're looking at a midstream company, part of that maybe you're trying to avoid that downside of being a producer. So Phillips 66 gives you a diversified business and you get a really good high quality dividend. The dividend yield's above 4%. It's not as high as you're going to get with Energy Transfer, but I think it's also more protected. And if you look at the dividend growth, since it was spun out of ConocoPhillips, they have grown the dividend substantially. So now they've held pretty steady on it over the past few years through COVID. But I think we're going to start to see dividend growth start to accelerate again. They're also really good at returning shareholder capital via buybacks. Since the spinout happened, they've reacquired almost 29% of shares outstanding. So that's a big part of their capital return initiative. So that per share focus on returns for investors, I think they got the right idea. I think they've got a great leadership team. I think of the price that it trades for now and the valuation. Again, you're looking for long-term growth. You don't necessarily need the income today at a high yield, but you want to see your yield on cost grow a lot. I'm going to suggest Phillips 66. Now, if you're looking for a higher yield today, Tyler, I think you've got one that's going to get people a little bit more interested.
Enterprise Products Partners. We call it a peer more than a competitor because their pipelines are all kind of geographically isolated. Enterprise Partners, same thing. Natural gas liquids is their big game, and they're the dominant player in the United States in this particular thing. Not only moving it from wellheads, but also processing it. They have a lot of things like ethylene plants, propylene plants, very much an integrated chain in this very specific part of the oil and gas value chain. They're the largest exporter of propane in the United States and actually the largest, I believe, propane exporter in the world, like larger than the whole country of Qatar. So it gives you an idea of the scale of this business. And with a forward yield right now at 7.5%, you're looking at a much more attractive yield than, say, like Phillips 66. Not the fastest growing dividend as of late because it is so large and there isn't as many growth opportunities as there has been in years past. But with a yield that large, it makes up for a lot of the lack of growth. It doesn't take as much, right? So I think if people are really interested in the space, I would like to push them away from Energy Transfer and a little bit more towards enterprise, which looks the same, but from a capital allocation, good steward of shareholder capital, they have done a much better job over the years.